I want to tell you something I said publicly in Omaha just a few weeks ago. Something that made headlines around the world, but that most people heard without really understanding what I was trying to say. We've never had people in a more gambling mood than now. I am 95 years old. I bought my first stock at age 11. I have watched every major market cycle the last 8 decades, the crashes, the bubbles, the recoveries, the manias. I lived through the dot-com collapse. I lived through 2008. I have watched this stock market do things that defied logic more times than I can count. And I am telling you right now, in May 2026, I have never seen anything like this. Berkshire Hathaway's cash pile just hit a record $397.4 billion. The Buffett indicator, which compares total U.S. market cap to GDP, stands at 229. 5% as of May 2026. I have previously described readings above 200% as playing with fire. The fire is burning now. I want to be very clear about something. I am not here to scare you. I am not predicting a crash tomorrow. I never make predictions like that. But I am here to tell you what I see, what 60 years of watching markets has taught me, and what I think every serious investor needs to understand before another day passes in this environment. Stay with me, because what I'm about to share is the most important thing I've said publicly since the 2008 financial crisis. People keep asking me the same question. Warren, why are you holding so much cash? Why are you sitting on $397 billion when the market keeps going up? Aren't you missing out? Let me explain my thinking, because it's actually very simple. In 60 years of investing, probably 5 of them have been really juicy. 5 years where I was genuinely overwhelmed with opportunity, where good businesses were trading at prices that reflected genuine fear rather than genuine value, where the phone was ringing and nobody was answering it. 5 years out of 60. That means in 55 of those years, patience was the right move, not urgency, not activity, not deploying capital just because it was sitting there getting larger. Tom Watson, Sr. of IBM, said it best when he was asked why IBM had been so successful. He said, "I'm smart at spots, and I stay around those spots." That is my entire philosophy in one sentence. I am not going to invest in things I don't understand simply because my cash pile feels too big. I am not going to drift outside my circle of competence to chase returns just because everyone else is chasing them. I am not going to buy overvalued businesses because the alternative, holding cash, feels uncomfortable. Right now, it isn't the ideal environment for my type of investing. And when it isn't ideal, I do nothing. And that's fine. Let me show you why the environment concerns me so deeply. The Shiller PE ratio, a broad price-to-earnings measure for the entire S&P 500, is currently at the second highest point in history, behind only the dot-com bubble. And it is very close to passing that peak. The Wilshire GDP indicator, which compares the total market cap of all U.S. companies to the GDP of the country, sits today at approximately 230%. We have never seen this metric so high, ever, in history. The danger zone begins at 120 to 140%. We are at 230. I have seen valuations like this exactly once before in my career at this extreme level. And I remember what happened next. Now, let me describe what I actually see happening in markets right now, because the valuation numbers alone don't fully capture it. I have compared financial markets to a church with a casino attached. People can move freely between the two. There have always been both investors and gamblers in the market. That's not new. What's new is what's happened to the balance between them. The casino has become enormously attractive. And the behavior I'm seeing, particularly around the one-day options, has crossed a line I've never seen crossed before. If you're buying one-day options or selling them, that's not investing. It's not speculating. It's gambling. Just totally. There's nobody that can explain why they're buying an option for one day. Let me put some data behind that statement, because this isn't just my impression. In 2018, the volume of options with expiry dates shorter than 1 week was far less than longer-term options. By 2026, that trend has completely reversed. Short-term options now dominate trading volume, more contracts expiring within a week than beyond a week, particularly in index and ETF options, people betting on the market itself, not individual companies. Think about what this means. An option that expires in one day, a bet on which direction a stock will move in the next few hours. There is no analysis that can reliably answer that question. There is no research, no business fundamentals, no understanding of competitive dynamics that applies to a 4-hour price movement. It is pure gambling dressed up in financial language. And prices for an awful lot of things will look very silly in retrospect. That is not a threat. That is just what happens when price disconnects from value for long enough. Eventually, always, without exception, they reconnect. If what I'm describing here is making you think differently about this market, hit that like button. It helps more people find this conversation. Subscribe if you haven't, because what I want to share next is the most practical thing in this entire video. Now, let me tell you why I don't try to predict crashes and why that actually makes me more prepared for them. People always want me to predict the crash. They look at my cash position, $397 billion, the highest proportion of Berkshire's total assets in at least 3 decades, above Central, and they assume I must be predicting something specific, a date, a trigger, a collapse. I am not. If you saw them coming, they wouldn't happen. You don't worry about what people are talking about. It's something that comes out of the blue. A nuclear event can come out of the blue. The Archduke getting shot in 1914 triggered World War I. Something will always come out of the blue. If people are already talking about it and thinking about it, that's not going to be the thing that causes the crash. Granted, surveys. That is the honest truth about market crashes that almost nobody in financial media will tell you. The events people are preparing for, the ones filling the headlines, the ones being discussed on every podcast and financial channel, almost by definition, those aren't the triggers. Because if everyone is prepared, the market has already priced it in. It's the thing nobody sees coming, the thing that arrives without warning. And that's exactly why worrying about it is terrible. It doesn't do you any good to worry. It is good to be cognizant. But the worrying itself, the constant anxiety about what might happen tomorrow, that's what destroys good investors. I don't like to cause that kind of belief in people. Branded surveys. So if I'm not predicting a crash, why am I holding $397 billion in cash? Because I'm not waiting for a specific event. I'm waiting for a specific condition. The most likely time to buy things is when nobody else will answer their phones, when the markets are collapsing and everyone is panicking, when liquidity dries up, when forced selling drives good businesses to prices that reflect desperation rather than value. That's when I show up with the checkbook. Duly, I'm not predicting rain, I'm building an ark, and the ark is $397 billion ready to deploy when the phone goes unanswered. So what does all of this mean practically? What should you actually do in this environment? Let me give you exactly what I would tell my own family. First, stay inside your circle of competence. Absolutely. I understand fewer businesses today as a percentage of the whole than I did 10 years ago. I have not learned new industries for some years. I don't kid myself. I'm not going to have an edge on younger people who actually grew up with these technologies, used the products, built things with them. The one thing I absolutely will not do is drift outside my core competencies to chase returns branded surveys. And I want to say this directly. The AI boom we're seeing right now is genuinely exciting technology. I am not dismissing it, but it is at a stage where there is no clear leader, no established moat, and no reliable way to predict who captures the value from it in 10 years. For most investors, and I include myself in this, it belongs on the too hard pile for now. Rule number 1 of investing, don't lose money. If you're not confident in the outcome, it is perfectly acceptable to pass. Second, value patience as a strategy, not a weakness. Charlie Munger used to say, we don't make money when we buy. We don't make money when we sell. We make money while we wait. The difference between mediocre investors and exceptional investors is always their temperament when conditions get sketchy. Branded surveys. When markets are overvalued, can you hold your nerve and resist throwing cash into overpriced speculation? And when markets eventually come down, can you control your emotions and invest with confidence rather than panic? That discipline, that temperament, that is the entire game. Third, Build your watch list now. The crash will not give you advance warning. The phone will go unanswered and the prices will fall faster than you can research. The investors who move decisively in genuine distress are the ones who already know exactly which businesses they want to own and exactly what price makes those businesses compellingly cheap. We can pick our spots. Nobody can tell us what to do. Sometimes we're doing nothing, but other times we get quite active duly. The activity comes from preparation, not from reaction. Before I close, I want to mention something I said in Omaha that received far less attention than my gambling mood comment, and I think it deserves more. The United States is not immune from runaway inflation. I referenced what happened just before Paul Volcker had to rescue the dollar. Americans at that time were borrowing money at 12% interest to invest in farmland, earning only 6% returns, purely on the belief the dollar would continue losing value. That kind of monetary psychology is extremely dangerous. And once it takes hold in a population, it becomes very difficult to reverse without enormous economic pain. I am not predicting hyperinflation, but I am saying the conditions that create it, excessive debt, political pressure on monetary policy, a population that loses confidence in the currency, those are not as distant as most people believe. Berkshire holds a record $397 billion in cash and short-term treasury bills. That cash represents more than 30% of Berkshire's total assets. Dash devs, that is not money sitting idle. That is money earning real returns in T-bills while I wait for genuine opportunity. And it is positioned to deploy at scale when the conditions I've described, forced selling, real fear, prices reflecting panic rather than value, finally arrive. If you want to understand exactly how to build the kind of patient investing system I've described here, the one that positions you to act when everyone else is frozen by fear, watch the next video in this series. It covers exactly where to put your money right now while you wait for the real opportunity. Link is in the description. Now, here's what I want to leave you with. I want to end with the most important thing I said at Omaha. The casino being crowded does not mean the church is closed. Long-term investors building diversified portfolios of good businesses at fair prices are doing something fundamentally different from traders buying one-day options. My warning is aimed at the gambling behavior, not at the underlying case for patient, disciplined capital allocation. That case remains as strong as it has ever been. America's economic system has worked extraordinarily well over time. It will continue to do so. The path has never been smooth, and it never will be. There will be crashes. There will be recessions. There will be moments when everyone is certain the end has arrived, and every single one of those moments in 8 decades of investing turned out to be an opportunity for the person who was prepared, who had cash, who had a watch list, who understood what they owned and why, who could stay calm when the world was panicking, be greedy when others are fearful, be fearful when others are greedy. Right now, bullish sentiment is elevated. Valuations are historically extreme. The gambling mood is at levels I have never seen before in my lifetime. That is not the time for urgency. That is the time for patience, for preparation, for building the ark quietly before anyone else notices the clouds forming. The 5 juicy years in 60, they come without announcement. They arrive when everyone else has given up looking for them. Be ready. The church is still open. Make sure you know which building you're walking into.